New Year and crisis continues. By the end of 2022, which was full of events, conflicts, crises and the world at the threshold of the new year, the data were conflicting at the economic, political and international levels. In the next few minutes, we will review some of the changes taking place at the economic level. U.S. Congressman and Chairman of the Senate Banking Committee, Sherrod Brown, said, in remarks reported by U.S. newspaper The Hill on its website, U.S. federal agencies need to address the digital currency market and possibly block it after the huge collapse of U.S. FTX specializing in the digital currency market last month. Brown added that the U.S. Treasury Department and all relevant agencies need to come together and assess any possible action related to the digital currency market. In the past weeks, the crypto sector has been plagued by several thunderous collapses that began in June. Collapse of stable currency Terra Luna UST, collapse and bankruptcy of the FTX platform, collapse and bankruptcy of BlockFi platform, news of imminent collapse of Gen's lending platform, news and doubts about the possible collapse of the world's largest digital currency platform. Benenz, the chairman of the Senate Banking Committee, said at the same time that it was difficult to enforce the ban on digital currencies in the United States because it would be directed to markets outside the country, and no one could predict what might happen as a result. This comes less than a day after the largest financial regulators in the United States expressed concern that there might be deeper links between digital asset companies and Wall Street. United States officials have long expressed concerns about looming threats from the digital asset sector, most of which operates within gray areas of regulation. The Financial Stability Monitoring Board, FSSC, said that the interconnectedness between crypto companies and traditional financial institutions remained limited, but warned, in an annual report, that entanglements could increase rapidly, putting the broader system at risk. Highlighting that there was some overlap, the board said that linkages could be strengthened, for example, by banks holding backup assets that supported so-called cryptocurrencies. The Financial Stability Monitoring Board added, these symbols act as a key intermediary between the crypto sector and the major financial world. The board identified several gaps in the current U.S. framework to regulate digital assets. The absence of federal control over symbols that are not legally considered securities under the Securities and Exchange Commission's jurisdiction, such as Bitcoin, will require Congress to enact a new law to correct this gap. Regulators must assess the potential vertical integration effect of crypto asset companies, based on proposals to give individual clients direct market access by eliminating traditional intermediaries. It should be noted that after reaching a total market value of $880 billion in the middle of the week, the total market value fell to $827 billion under the fund's outflows. After the frightening news in the cryptocurrency market about the crisis in the world's largest cryptocurrency exchange, Benenz, it appears that feelings of extreme fear are on the way to dissipation. The Benenz Queen symbol succeeded in halting a violent series of losses during which it lost nearly a quarter of its value following news of the imminent tumble in the currency market. Meanwhile, public sentiment in the cryptocurrency market remains downward after the Fed's indication that interest rate hikes will continue in 2023. Days ago, the U.S. Fed criticized the early celebration of markets and asserted that efforts to fight and curb inflation continue until the Fed's targets are met. U.S. Treasury Secretary Janet Yellen earlier predicted that U.S. inflation would fall in 2023, and Yellen said that by the end of next year, we would see inflation much lower if there was no unexpected shock, adding that there was a risk of a recession, but it was certainly not necessary to lower inflation. Morgan Stanley's strategist Michael Wilson argues that U.S. stocks are heading for their worst years since the global financial crisis, and that corporate profits are about to meet the same fate. Morgan Stanley's strategist said the looming earnings slump may itself be similar to what happened in the 2008-2009. Michael Wilson added that this could lead to a new stock market decline that is much worse than most investors expect, he wrote in a note. Goldman Sachs Group Incorporated strategists also warned about the risk of profit margins in the year ahead as inflation remains high. We still have a long way to go, we're far from the price stabilization goal, San Francisco Fed President Mary Daly said over the weekend at a virtual event hosted by the America Enterprise Institute. The Federal Reserve raised interest rates 50 basis points this week to 4.25% and 4.5%, after 4 consecutive 75 basis point increases. Jerome Powell's clear message to the markets about not being lax in the face of inflation seems to have already reached the managers of the world's largest funds. According to the news, the world's largest money managers are set to offload up to $100 billion in shares in the last few weeks of the year. Stock sales have seen a surge that has escalated dramatically since Jerome Powell's clear message that policymakers will continue stringent tightening measures under the risk of job cuts and recessions. The latest blow came on Wednesday when Chairman Powell warned that interest rates would remain high to tame inflation at the end of the Fed's last meeting in 2022. The Federation has dashed hopes that the central bank is preparing to curtail its violent militarization campaign. Instead, policymakers indicated that they would continue to climb to a peak beyond what the market expected. But beyond what is going on in the market for currencies, stocks and bonds, what about political events that have a strong impact on the world economically and administratively? European Energy Commissioner Kadri Simpson said when she arrived at a meeting of EU energy ministers in Brussels on Monday that agreement on a cap on EU gas prices was within reach. European Energy Commissioner Kadri Simpson added, "I strongly believe that agreement is within reach. This, of course, requires a very strong desire for consensus from all, as ministers will try to approve it." This refers to Russia's proposed gas price cap, which the states of the Federation failed to agree on at the last meeting. The Greek energy minister said that the latest proposal to cap gas prices at 188 European euros per MWh gives a correct indication of the market situation. The Minister of Energy of the Republic of Malta said, "We consider the presentation of the maximum gas price as a good step in the right direction." EU Energy Commissioner tipped agreement to cap gas prices and calls on EU countries to compromise. European Energy Commissioner says gas price cap agreement is within reach. Europe began its biggest energy crisis in decades, after its energy bill reached $1 trillion as one of the aftermath of Russia's war in Ukraine. The region will have to refill gas reserves with little or no supply from Russia, increasing competition for liquefied gas shipments. Even with more facilities to import LNG, the market is expected to remain tight until 2026, when additional production capacity is available from the United States and Qatar. Moving from gas through oil. After the price fall last Friday, oil succeeded in rising Monday thanks to growth and optimism about recovering demand from China, the world's largest oil consumer, as lockdown days continue to ease. The rise in oil during the day's trading has boosted declines in the dollar index, which reduces the cost of buying, transporting and securing oil in conjunction with Washington's decision to rebuild strategic inventory. ANS research analyst said in a note, tighter monetary policy already has an impact on industrial activity. The prospect of further emphasis in the wake of hard-line comments from policymakers has affected sentiment. The U.S. Federal Reserve has indicated it will raise interest rates further in the coming year, even as the economy slides into a possible recession. In contrast, the oil market faces negative pressure, including slow recovery of Chinese demand. Due to the inflated number of coronavirus infections, analysts from Haitong Futures said investors are now very cautious because the market is full of variables. The International Energy Agency, IEA, forecast Chinese oil demand to recover next year after shrinking in 2022 to 400,000 barrels per day, BPD, raising its estimate of oil demand growth in 2023 to 1.7 million BPD. On Tuesday, OPEC met its forecast for global oil demand to grow by 2.55 million barrels per day, BPD, this year and 2.25 million BPD in 2023 after several cuts. Analysts from JPM also expect the U.S. to begin replenishing its strategic oil reserves in the first quarter of 2023. Based on our quarterly forecast, this buyback window will open in the first quarter of 2023 with an initial purchase of approximately 60 million barrels over the first half of 2023, said JP Morgan analysts. The U.S. Department of Energy announced on Friday that it would begin repurchasing crude oil in order to strengthen the Strategic Petroleum Reserve to support expectations of higher prices. This will be the first U.S. purchase since the release of 180 million barrels of inventory this year, which is a record amount, after dropping to record levels of 420 million barrels. Do these reports and indicators lead to increased optimism next year, or do they indicate more caution and expectation? Will the global political situation between various states continue in 2023, or is there any other view? That's what we're going to see in the coming episodes. Follow us